Hello, investors, and welcome back to the channel. In a world of market volatility, high inflation, and geopolitical uncertainty, where can you find safety and a reliable, growing paycheck? Today, we might just have an answer. We're diving deep into the latest earnings report from one of Asia's largest healthcare real estate investment trusts, Parkway Life REIT, or PLife REIT. Why should you care about this? Because this isn't a flashy tech stock. This is a company that owns the essential buildings, hospitals, and nursing homes that we all need. They just announced their results for the first half of 2025, and the numbers tell a story of quiet, steady, and relentless growth. Is this the ultimate sleep well at night dividend stock for your portfolio? Let's find out. But before we dive in, just a quick disclaimer, this video is for informational purposes only. It's not financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. All right, let's get into it. So, who is Parkway Life REIT? Simple. They are a real estate landlord for the healthcare industry. Their portfolio, valued at a massive 2.46 billion Singapore dollars, includes 75 properties. This isn't just any real estate, it's mission critical. They own 3 of Singapore's most well-known private hospitals, Mount Elizabeth, Gleneagles, and Parkway East. Think about that. These are top-tier hospitals providing essential services. On top of that, they've diversified into aged care, owning 60 nursing homes in Japan and more recently 11 nursing homes in France. This is a classic defensive industry. People get sick and get older regardless of what the economy is doing. This gives PLife REIT a very stable and predictable income stream. And in the current environment with an aging global population, the demand for high-quality healthcare facilities is a long-term tailwind that isn't going away. Okay, let's look at the headline numbers for the first half of 2025, and the story here is all about steady, positive growth. First up, gross revenue. It came in at $78.3 million, which is an impressive 8.1% increase compared to the same period last year. This growth was driven by contributions from their recent acquisitions, particularly the new nursing homes in France and Japan. Next, net property income. This is like the gross profit for a real estate company. NPI also rose by 8.0% to $73.8 million. This shows they are managing their properties efficiently. But for a REIT investor, this is the number that really matters. Distributable income to unit holders. This is the cash that's available to be paid out as dividends. This figure grew by a very healthy 9.5% to $49.9 million. And that translates directly into the distributable income per unit, your paycheck. The DPU for the first half of 2025 increased by 1.5% to 7.65 Singapore cents. Now, 1.5% might not sound like a huge jump, but it's important to remember they also issued new units to fund their growth. So growing the per unit payout on an enlarged base is a very positive sign. So where is this growth coming from? It's not just one place. PLife REIT's strategy of geographic diversification is clearly paying off. First, Singapore. Their Singapore hospital portfolio remains the bedrock, making up about 65% of their revenue. It provides steady, predictable income thanks to long-term leases with built-in rent increases of 3% per year through 2025. It's the anchor of stability. Second, Japan. The Japan portfolio with 60 nursing homes also saw higher revenue from an acquisition in August 2024. However, this was partially offset by the depreciation of the Japanese yen, which is a key foreign currency risk we'll talk about later. And here's the exciting part. Their new European frontier, the 11 nursing homes in France acquired in late 2024, contributed a full 6 months of income for the first time, adding $5.8 million in gross revenue. This shows their strategy of expanding into mature European healthcare markets is already bearing fruit. Now, how did these results stack up against expectations? The report doesn't provide specific Wall Street analyst forecasts, but we can read between the lines. Parkway Life REIT is not a company that promises the moon. It aims for steady, resilient, and predictable returns. And on that front, they delivered exactly what they promised. The continued growth in revenue, NPI, and most importantly, the DPU, demonstrates that their strategy of disciplined acquisitions and strong financial management is working as planned. In an uncertain market, meeting your own goals of stability and steady growth is a huge win. You don't have to take my word for it. Let's look at what the CEO, Mr. Yongyin Chao, had to say. He stated, "Our resilient 1H 2025 results reflect the strength of Parkway Life REIT's core portfolio and our commitment to disciplined growth. The expanded contributions from Japan and our successful entry into France have further diversified our income streams while remaining aligned with our focus on resilient, healthcare-related real estate." This quote perfectly summarizes their strategy: resilience, discipline, and diversification. He also highlighted the REIT's financial health, adding, quote, "With no refinancing needs in the near term and a high degree of interest and currency hedging, we are well positioned to navigate market volatility and continue delivering sustainable returns to our unit holders." That is exactly what income investors want to hear. Looking ahead, management isn't signaling any radical changes, and that's a good thing. They are sticking to their playbook. First, they acknowledge the macroeconomic uncertainties out there, but they emphasize that the healthcare industry remains resilient due to aging populations. Second, their financial position is a fortress. Their gearing ratio, which is like a loan-to-value ratio, is at a very healthy 35.4%, well below the regulatory limit of 50%. This gives them plenty of debt headroom to make future acquisitions without stressing their balance sheet. And here's a critical point in today's interest rate environment. Approximately 97% of their interest rate exposure is hedged. This means they are largely protected from rising rates. Furthermore, they have no long-term debt refinancing needs until September 2026, which is a massive advantage that removes a lot of near-term risk. They're also actively hedging their income from Japan and France to protect against currency swings. So, how has the market been treating Parkway Life REIT? Let's look at the unit price relative performance chart from their presentation. The pink line is Parkway Life REIT. As you can see, its performance has been generally in line with the broader Singapore market, the STI index, but has significantly outperformed the S-REIT index, which tracks other Singapore REITs. Given these solid defensive results, the market will likely react positively. We may not see a massive price spike because this isn't a growth stock. Instead, investors will likely appreciate the reliability, the growing dividend, and the impeccable risk management. In a market hungry for safety, Parkway Life REIT stands out as a dependable performer. All right, let's tie this all together. What does this earnings report mean for you as a potential investor? Let's start with the opportunities. 1. Uninterrupted DPU growth. Since its IPO, Parkway Life REIT has delivered steady and recurring DPU growth. For income and dividend investors, this is the holy grail. They have a clear track record of consistently increasing their payout. 2. A fortress balance sheet. This is arguably their biggest strength right now. The low gearing, hedged debt, and no near-term refinancing needs make it incredibly resilient to the biggest risks facing REITs today: high interest rates. And 3, smart diversification. Their expansion into France is a savvy move. It diversifies their income away from a pure Asia focus and gives them a foothold in the large, mature European healthcare market. Now, what about the risks? First, foreign exchange headwinds. As we saw with the Japanese yen, their international income is subject to currency fluctuations. While they use hedging, it's a risk that will always be present for a company with international assets. Second, valuation. Parkway Life REIT often trades at a premium. The market is pricing in its quality and safety, so you're paying for that stability. And 3, limited explosive growth. This is a feature, not a bug. If you're looking for a stock to double in a year, this isn't it. The growth here is slow, steady, and, dare I say, boring, in the best way possible for a dividend investor. Overall, the thesis for Parkway Life REIT is clearer than ever. It is a premium, defensive, income-generating machine. It offers a unique combination of stability from its Singapore hospitals and long-term growth from its overseas aged care properties, all backed by one of the strongest balance sheets in the sector. So there you have it, a deep dive into Parkway Life REIT's first half 2025 results. A story of steady growth, smart management, and a focus on delivering sustainable returns to investors. It's a prime example of a company that prioritizes stability in an unstable world.
What do you think? Is this the kind of defensive dividend stock you'd add to your portfolio? Let me know your thoughts in the comments below. I read every single one. And if you found this breakdown helpful, please do me a huge favor and hit that like button and subscribe to the channel for more deep dives into the companies and market trends that matter to you. Thank you for watching, and I'll see you in the next video.